Well, welcome everyone to today's podcast. We have a very special guest with us, joining Adam Skipniewski, who is the managing director of Equity Institutional Services. He has a 17-year track record of, really simplifying the self-directed IRA process for investors. Of ours have used this tool to really invest in multifamily and invest in other funds that we have. So we're super excited to hear about your expertise across the spectrum in private credit, private equity, venture capital. I know you work on a lot of different things. Um, Adam's role for everyone here at Equity Trust is new business development. And so he focuses on their self-directed IRA and private fund custody services, as well as their 1031 exchange, which we're very familiar with in the real estate space. And he works closely with deal sponsors like us and then investors like you, providing solutions to help smart investors really mitigate and manage their taxes ultimately. And so Adam, born and raised in Chicago, I think he lives in Naperville, Illinois right now with his wife and two daughters, and holds a business management degree from Michigan State. And so, Adam, we're super excited to have you on with us. Today we're really excited to dive into four key questions here, really to
Yeah,
simplify the self-directed IRA process and provide insights to our investors and all the listeners here as well. What is a self-directed IRA? How can you move money from a traditional or Roth IRA into a self-directed IRA? Why have 350,000 plus people, partnered with Equity Trust and you to really move from a traditional and Roth to a self-directed IRA, and why is that movement really happening? And then how can you, invest in real estate and all of these other diversification plays through a self-directed IRA? So really excited to get into all of it with you. Thank you for being here. And so, would love to kind of hear your story and then Equity Institutional Services story as well and what y'all do. And
mhm.
I will just pull up the presentation as well so that everyone can see it.
Excellent. Excellent. Yeah, Denver, thank you so much for having me. Thanks to JT Capital for hosting us tonight. I think this is a really exciting topic that, I'm passionate about bringing to the masses. Obviously, as you mentioned, I've been doing this for 17 years. So I've hoped that I've picked up some wisdom for the audience tonight and going forward that they might find beneficial. As you mentioned, Denver, this is just a creative way for people to get involved with passive investments like those offered by JT Capital and in the real estate space and the private credit space. To give you a little bit of my background for the audience, just before we kind of get into the presentation, Denver. Again, I'm a 17-year veteran of this industry, the self-directed IRA industry. I've been working with alternative investments within IRA accounts and other types of accounts, and all types of assets, whether that's real estate, hard assets, private equity, venture, hard money lending, angel investing. These are all the things that we can do or that we come across in the self-directed world. And that's what's really kind of brought out my passion and kept me, 17 years strong in this space and will keep me for at least 17 more. I guarantee it, because it's just, there's so much that we can do. And as the slide says, so much that we can unlock and access when we consider our retirement account as a pool of capital for us as investors. It's access, right? We can get involved with more deals, more projects, more opportunities. And so, the 17 years that I've spent in this space with Equity Trust, Midland Trust, and others, focused on helping deal sponsors raise more money that might be sitting in their investor retirement accounts. I've been working with individual investors about how they treat this as a diversification tool, as you mentioned, Denver, because that's truly what this is, right? Anybody can set up an IRA and go invest in the S&P or buy Nvidia stock. But for those that are curious, those that are passionate about finding opportunities, self-direction is a great tool. So I hope within the course of today's presentation, today's conversation, we give the audience a good understanding of what self-direction means. That we can self-direct our traditional IRA, we can self-direct our Roth IRA and the like. We'll get into all that in the coming slides, but I want the audience today to walk away with a firm understanding of what self-direction is, and ultimately to know that they can find a resource for the self-direction in me. And if they ever have questions or curiosities about what this means, that they should feel welcome to come to me, and the folks should find my contact information right there on the first slide.
Yeah, well, I love the passion, Adam. We have the same passion in doing what we do in real estate. So I love the passion and expertise that you bring, and I'm really looking forward to uh, having this be a resource for our listeners, because I think everyone's going to learn a lot today. So we can dive right in.
Yeah. So I'll give just a brief overview of who Equity Trust and Equity Institutional Services is. So again, my name is Adam Sipniewski, and I manage the institutional services team here at Equity Trust. The institutional services team is a newer division of Equity Trust, or perhaps I should say rebranded division. I was with an outfit called Midland Trust for the past 7 years, up until about this point last year in 2023, because Equity Trust acquired my former employer, Midland Trust. We still do the same sort of self-directed work. We just kind of do a different way. We, Midland Trust, we always worked very well and very closely with not only the individual investors that are using their IRAs to diversify, but also those product sponsors, those investment sponsors that they're choosing to invest with. Midland Trust kind of made their name working with not only those LPs, but the GPs as well, and making a great experience for all those involved, the capital raiser and the investor. And so again, as the slide says, we were acquired late last year by Equity Trust, and are now known as Equity Institutional Services because of our accommodation for those institutions that are raising money from IRA investors. And just a couple of stats that, yes, as you mentioned, Denver, at the top, we have now over about 360,000 clients, and about 52 billion in assets under custody. So, where Midland was acquired was a great opportunity for us and our team to join Equity Trust and their 50 years of experience in this space. And as you can see, the considerable assets. They are definitely one of the original players in the self-directed space, and we're very fortunate to be a part of them and utilize their resources and brand. But as you can see there at the bottom, as Midland Trust, we were recognized as the best custodian for private equity investing. So this is, as you mentioned, Denver, something that I'm passionate about and my team is passionate about. So not only private equity, but across the private placement investing space.
Yeah, that's fantastic. The big question of why everyone is here,
Yeah.
what is a self-directed IRA? I think we'll start there.
Yeah. Very simple. Keep it simple, right? And self-directed, really, folks, it's just a marketing term. So, you might have a self-directed IRA or what's called a self-directed IRA at like a Fidelity or Schwab. But what we mean when we say self-direction, and what the industry broadly means, is that you're using your IRA to invest in something private, something non-traded. So, yes, you can have a self-directed account at a Fidelity or a Schwab because you're picking NVIDIA stock, or you're picking, this ETF or SPIDE or whatever. What we mean with self-direction is you, the IRA account holder, are going out of the market and finding a private opportunity to invest in, something like those offered by JT Capital in the real estate space or private credit space, or any of those things that we kind of said at the top of the conversation, Denver. And that's what we mean when we say self-direction. So again, you can self-direct your traditional IRA. You can self-direct your Roth IRA. So it's not a separate kind of tax status. It's just a descriptive term to let us know, or let the community know that the IRA account holder has picked this investment themselves. They're not advised. They're not picking from a curated list, from a broker that might be earning a commission from these products. These are truly, directed investments by the account holder, by the IRA investor. So a lot of what we see what we saw at Midland, and now what we see as Equity Institutional Services, is a focus on passive investing. Private funds, whether that's a real estate fund or a private equity deal, a hedge fund, and the like. Those are really what we've seen a migration towards with retirement accounts, because these are significant amounts of money. People like to, quote unquote, set it and forget it with their retirement accounts. They traditionally have longer time horizons, those 3 to 5 year periods. They don't need cash flow, because this is a kind of bucket that's set aside for retirement. So a lot of times we're finding ourselves in front of these passive types of investments, not so much the active, the nitty gritty, the landlording and with your IRA dollars and the like, Denver. So the one kind of key point that I'd want the audience to take away from this slide is that while we use the term self-directed, you cannot do it yourself. You do need to hire a custodian. You do need a record keeper to keep that tax status in place. So I know there's some sophisticated folks in the audience tuning in. Make sure that you work with a custodian like an equity trust or someone else to make sure that you're reported on correctly to keep that tax shelter in place. You can't just go out of this alone. You do need what's called a qualified custodian to do self-direction. You just need to find the right custodian for you.
Thanks, Adam. So one of the questions I frequently get is, how do I put money into a self-directed IRA? If
Yeah.
I have $6,000 or $7,000, and you can talk about the limits a little bit, in a bank account, how do I move that into a self-directed IRA? Or do I need to have a job that offers me, a traditional or Roth IRA, and then I convert it? Can you kind of just talk about that a little bit? Like, how do I fund this self-directed IRA?
Yeah, it's a great question. And it is a common question. So big thing to keep in mind with IRA folks is that, this is not a sponsored plan like a 401k through our work, that we just contribute to and we just kind of set it up and they take care of, the employer or a plan administrator takes care of everything. An IRA is your own account. You are, the managing member, so to speak, where you have to set it up. You have to go to a financial institution to open up that IRA. And you have 3 ways in which you can fund an IRA. What you were kind of alluding to earlier there, Denver, was what we know is as a contribution, and that's really anybody who has an earned income can contribute to an IRA. You can contribute up to $7,000, and and then you have a catch-up contribution if you're over the age of 50. It's like $1,000. So a lot of folks, if you're socking money away, so to speak, and starting up, that's how people kind of get started as a young person. They're making just those direct contributions. But for those of us that have been in the the labor force for some time, we might have benefited from an employer contribution plan like a 401k, like a something where we're being matched by our employer with our contributions to said plan. Most commonly, we know the 401k or maybe a 403b for our teachers or nurses out there. But these plans are, again, employer sponsored, and they typically aren't allowed to be rolled over, meaning you can't get your cash out of that plan until you reach the age of 59 and a half, which is retirement age, or you have a separation of service, which means you've left that business, you've retired, or you've changed jobs. And that's when that 401k becomes portable. And so that portability of an employer plan, that's the second most common way that we see these IRAs funded. So again, if you've been in the workforce for a number of years and you've accumulated a 5-6 figure balance in your 401k because of those employer matches, that's a considerable balance that you can then roll over to an IRA. And then, instead of, say, taking it to your next employer plan where you're still limited by what they curate for you in terms of target date funds or other strategies, instead of rolling that 401k into your next employer's 401k, you can roll it into an IRA and be free and clear to really invest how you want to and in what you want to, what you're passionate about. Now, the most common and third way to fund an IRA is just slicing off a piece from your current IRA and bringing it in. We call that an IRA transfer. So a lot of folks, they might have rolled over that 401k from a previous employer, like I just described, Denver, and they bring it to a Fidelity. They have an IRA there. That is portable in itself. An IRA, you can move funds between IRAs. It's called a trustee to trustee transfer or an IRA to IRA transfer. There's no tax liability. There's no limit on the amount of transfers that you can do in a year, as long as you're going from IRA straight to IRA. And again, that is the most common way we see folks set up a self-directed IRA. Is they say, Adam, I've got this considerable IRA at Charles Schwab, but I'm looking at a specific deal with JT Capital. I want to carve off, slice off 100K, 250K to bring over into a self-directed IRA so that I can invest in an upcoming deal with JT Capital. And so that is, again, the most common use case or common way that we see folks fund their IRAs by transferring from an existing IRA, but they have those two other options being the rollover of an inactive employer plan, or the third way being those $7,000 contributions, annual contributions.
Yeah, that's fantastic. And so, for the investors joining us today,
Yeah,
if you want to do this yourself and you have $7,000 in a bank account, you're looking at option one, which is contributing, $7,000 to a self-directed IRA yourself. It's analogous almost to opening a bank account at Bank of America. Now, the difference is the tax benefit that you get. If you open a bank account and keep that $7,000 there, I mean, the interest rates at some of these national banks are close to zero as possible. You can take those dollars and invest it in either stocks, bonds, or even real estate and other assets that we're going to dive deeper into, earning a significantly better rate of return over the long term than keeping it at a bank. So definitely there's risks associated with every investment, but at the same time, investing it prudently, investing and diversifying your money can really lead to some amazing impacts over a long period of time. And so that's number one. For both the other options, which are really employer sponsored plans, the 401k, the Roth IRA, or the traditional IRA. If you have those, that's fantastic. Not everyone does, but those are easy ways to transfer it as well. So that definitely makes a lot of sense. And those three ways are definitely ways that we have seen in the past as well. So I guess one thing that I'd love to kind of touch on here is that tax benefit that I talked about. So a 401k, your money is coming straight from the employer pre-tax into a 401k account, and then it's tax deferred where you get taxed at the end. With
right.
a Roth or traditional IRA, you're actually getting taxed up front and then putting it in, and then having it grow tax free. So can you
Yeah.
talk a little bit about self-directed IRA, and is there a difference in the 401k versus sort of the self-directed IRA?
Yeah, so the tax treatment all comes down to what you just pointed out, Denver, and that's when we use the term traditional versus the term Roth. And so um, most things, if they're not denoted Roth, we're going to assume they're traditional, and that means free tax. So tax has not been taken. So some folks in the audience might be familiar with when you do make those contributions to a traditional IRA. In some cases, you can write that off your tax bill at the end of the year. You can write off that $7,000 contribution if you're within a certain income limit. Other folks, can't. But the point being that you're not taxed on the way in with a traditional. You're taxed on the way out. And so what I mean by that, folks, is that you make these contributions that you might get a write off for on the way in because you're under a certain income limit. Perhaps you didn't qualify, but in any case, those dollars go into a traditional account, whether it's a 401k or an IRA. They go in pre-tax. So that balance, those investments, those are growing, those are living, those are giving you your returns, all within the tax shelter of your IRA or 401k. Still no tax has been taken. The way that the tax treatment kind of plays out is on the back end when we start distributing from these accounts. So when we take a distribution from our IRA, meaning we take cash, like, hey, Equity Trust, send me a check for $5,000 from my IRA. Okay, that's when it becomes taxable. When you take cash away from the IRA, out of the 401k or out of the IRA, and deposit in your bank account. And it's treated as regular income. It's reported on a 1099-R. So that means it's on your bottom line income for the year. So if you're working, it's going to sit on top of whatever you earned for the year. If you're not working, well, that's how you fall into a lower tax bracket, right? And that's how we find people mitigate taxes or their tax liability in retirement or non-working years. With Roth, that those are post-tax dollars, as you pointed out, Denver. So we've already paid taxes on these dollars before they go into the Roth account. And so when those balances get in the Roth account and they start getting invested in things, that growth is tax-free, as you mentioned. And that's why Roth is just so incredibly powerful, especially for those that have a longer investing time, investing horizon. For those 20-year-olds or folks just joining the workforce, start a Roth if you can, because that compounded tax-free growth is incredibly life-changing and impactful. Because once you clear what's called the 5-year aging rule, your basis and your gains on that Roth account is tax-free, and that is a considerable impact when you think about 5, 6-figure, 7-figure balances within a retirement account that a lot of people find once they've been been investing for decades. And so again, I strongly encourage anybody to just open up a Roth so that you can start chipping some dollars in, because that's really going to impact your livelihood in retirement. Because again, you've already you've paid the tax on those dollars before they went into the Roth, so everything that you take out tax-free, again with some considerations with the 5-year aging rule and the like. But if you get started early, it's going to be impactful. And that's the major thing that I would communicate is, again, self-directed. We can self-direct our traditional, self-direct our Roth. It's that traditional versus Roth. That's going to be how we figure out the tax treatment of those dollars.
Yep, that's great. Thank you for explaining. And we have some financially savvy people on here, and so we're real estate investors. We don't like taxes, and so a lot of investors talk about the backdoor Roth
Oh
IRA
yeah.
conversion too. And I think a Roth over period of 20 years or so can really, really change an investment like outlook and outcome because of the compounding interest that you get to keep rather than get taxed on the back end.
Mhm.
So yeah, definitely interesting and good to know that there's both a traditional and a Roth self-directed IRA. That's definitely a frequent question. You mentioned the 5-year aging rule. Like, can you talk a little bit about that? Like, what does that mean? What do investors have to pay attention to there?
Yeah, so all that means, like very simply, succinctly put, is that your gains, anything that you earn off of your basis, like say you make that $7,000 contribution to your Roth, and then you invest in something for that whole $7,000. Whatever you earn on that $7,000 is your return, your earnings on your investment. That needs to remain in the Roth account for 5 years before you distribute, if you want it to be tax free. If you took it
Hmm.
out before that 5-year aging period, it would be considered taxable. You also have to meet the age requirement of being 59 and a half to avoid any taxes. But again, you want your returns, your performance to be in your Roth account for 5 years before you distribute it. That's how you make it completely tax free.
So let's work through like one scenario. So let's say either I'm 54 and decide to sell an investment. Is that kind of how you're thinking about it? And saying, I want to sell a lot by either, not everything, but I'm just saying by 54, you sell a portion of it. You have, the gains sit there for about 5 years. Can you invest the gains into something while you wait for those 5 years, or is that, different? Um, kind of investment altogether.
Oh yeah, yeah. I mean, so the important thing is to have that 5-year timestamp on the Roth. So yeah, if you have like once that basis is within that Roth, Denver, then we're good. Like we just need that contribution made, and then 5 years from that contribution date, that fifth year actually. So if I made it today on July 25th, 2024, by 2029, I'd be able to withdraw though anything that I earn on that basis tax free on Jan 1st, Jan 1 of 2029. So yes, you can reinvest those gains in something else, but yes, that 5-year period relates to that first 5 years that you've placed that initial basis and those earnings on that basis. So in my example, once I hit 2029, I'm free and clear. I still have to disclose that I'm not a CPA, I'm not a tax advisor, so I would suggest everybody consult their tax advisor. But anecdotally speaking, that's how that would apply.
Yeah, super helpful. So why don't we jump into, why people convert from a traditional Roth or Roth into a self-directed traditional Roth IRA? And you have a couple of items here that we can talk through.
Yeah, yeah. So I mean, notably Denver, and I think the audience does realize is that this is a diversification strategy. A lot of folks have their IRAs at Schwab or Fidelity and invest in the S&P. It's been a good time to do that the last couple of years, but um, not everybody wants to be 100%, exposed in the stock market or in equities or in, bonds or whatever they might do. So they want to make an investment within their retirement account and something truly diversified, not Vanguard's total real estate fund, but an actual specific deal in their community. So diversification, right? I mean, whether it's real estate or metals or crypto, that's anything under the sun, just to get diversified. That's really the main reason that folks are coming to us to do this. But as I mentioned kind of when we were talking about how we fund these IRAs, Denver, a job change is usually like a big life event that triggers some movement towards self-direction, because that's a balance, that old 401k, that old employer plan that they had, Denver, they then use that to do something unique. They roll it over into a self-directed account, and then they start real estate investing. And that was their entry point. And that's really kind of the other kind of unnamed reason here, is that access. And I kind of mentioned that earlier, but for a lot of folks, they have illiquidity, or they've exhausted all dollars in their taxable accounts, in their checking account, and their savings account. They don't have 50 or 100K lying around to get into a syndicated offering or a private fund. But they know that strategy will deliver returns. So what they do is they turn to their retirement account, where they, in most Americans, I think it's like 55% of Americans have the majority, or excuse me, let me repeat that. 55% of Americans' investable wealth is within a retirement account on average. So that means most of our investable capital is within a retirement account. Could be in a 401k where we're maybe limited to an employer plan, but once we get out of that plan, we can then access all these types of alternative investments if we go that self-directed route. And again, with most of our wealth being there, some of these offerings being accredited only, that can make a significant impact on the returns that you can achieve with the dollars in your IRA, as opposed to the dollars in your checking account or other investment accounts. And obviously, the last reason that I have mentioned here, Denver, is really the tax mitigation. So again, as I just mentioned, I disclosed I'm not a CPA, I'm not a tax advisor. But as you can see, retirement accounts are tax strategies in their nature. As you said, the audience here and really everywhere, we don't like taxes. We want to mitigate that liability that we owe Uncle Sam. And so by using our IRA, that introduces a strategy by which we can mitigate the tax hit. Think about it with a traditional IRA. I mentioned we're taxed on the back end when we take dollars out. If we're not working, if we're not earning an income at that point, history would tell us that we would be in a lower tax bracket, and thus taxed less dollars on the amount that we're bringing out of our IRA, as opposed to we brought it out when we were still working, and we're in a much higher tax bracket. So if you're looking to mitigate the liability that you owe the government in form of taxes, that would be the last and last of the most popular reasons that we see, along with the diversification, job change, access and illiquidity. Tax mitigation would be up there as well, Denver.
Yeah, so digging into diversification here, like most of the investors on this call really want to know, how can I use my self-directed IRA to invest in multifamily syndication? Because that's the big question here.
Yeah.
How is it better than investing through a bank account? It's not even possible doing it through your traditional or Roth IRA, so you're kind of limited there. So obviously a huge benefit to self-direction. Can you talk through a little bit of that, and maybe just give an example of something that you've worked on in the past of an investor wanting to be, invested in multifamily as a limited and passive investor, and able to do that through a self-directed IRA?
Yeah, and this is what we do day in, day out, Denver, here at Equity Trust, and with my institutional services team. It's something that we're passionate about, and that we've made it our intention to support, is this passive investing with retirement accounts. It's really quite easy. It sounds cumbersome, and maybe some members of the audience may have had a unsavory experience, because self-directed industry has traditionally been a cumbersome and outdated process. But here at Equity Institutional Services, we've made it our mission to simplify this process and make it as streamlined as possible. So when we talk about investing in a passive deal with our IRA, um, it's a lot like investing directly, but instead of those sub docs or those LLC agreements, those investment documents that we see when we're doing our due diligence on a deal. We're reading that PPM, we come across a sub doc, or a schedule of members. Instead of subscribing yourself, Adam Sipniewski is a subscriber to JT Capital Fund One. It would be equity trust for the benefit of Adam Sipniewski's IRA as a subscriber to JT Capital Fund One. So and that's a service that your custodian, that's what Equity Trust does, and we make sure that's like a key piece in terms of reporting, in terms of keeping that tax shelter in place. But to the investor, to the audience, really, like it could be in fact easier to go through your retirement account, because once you've set up that IRA account with us, which is a simple online process, which we'll show at the close here, the presentation. But we open that IRA online, Denver. We bring cash into that IRA, and then we invest in our deal. And what we do here at Equity Trust is we don't leave our clients just to figure it out on their own. We're going to quarterback the investment process for you. So, that subdoc process that I was just taking you through, the audience doesn't have to remember, oh, I got to use Equity Trust for the benefit of my IRA, or what is their tax ID instead of my social. No, we take care of all that process for you. So when I say easier, I mean that we kind of take that burden of the investment paperwork off of our clients, fill it out properly, the name of the IRA. But that's really the magic of how this is done, as opposed to our direct accounts. If anybody that's listening here tonight, has invested with JT Capital or another, offering, they might have, just took a pen and a paper and just said, filled out those sub docs by hand or on their computer, whatever, DocuSign, and send it back. Again, we're going to do all that for you in the name of your IRA, and make sure it's not held by you personally, because that's the magic of keeping your taxes sheltered from the performance of this investment. So it's not too much different. It's just a little bit more of a front end setup, Denver, that I would say, in terms of they got to open that IRA with us, that we got to bring cash in. But in any case, all these steps, opening the IRA, funding the IRA, and making that private, that passive investment, we're going to hold your hand through that process, so that there's no guesswork, that make this as easy and streamlined as possible, so that what sounds complicated and timely really takes about a week to do, and we do most of the lifting for you.
Yeah, and that's something I want to just mention to the crowd listening. Not all self-directed IRAs do this. This is actually a very unique and hugely beneficial offering that Equity Institutional Services is providing, with the reading of the docs, with filling it out, and really not handholding, but just helping it to the finish line. And the process is extremely streamlined. It's actually not the norm. And so it's actually very refreshing to hear the process and the timeline, and the service really taking over and helping investors get to the finish line, because it can be a worrisome problem that folks don't really almost are burdened to taking that first step because they think it's going to be too painful, versus what you're saying is it's a 2 to 3 week process, and over a 20 to 30 year timeline, you're going to improve returns by 200%. Like, I mean, take the effort, take the time, really figure this out, because that could mean $1 million, or it could mean $5 million. That's a very, very big difference over a
Yeah,
long period of time, depending on which type of account you hold these investments in.
exactly, Denver. And you make a great point. A lot of times folks that are self-directing, they're doing it for the first time, and we realize that. And it's easy to get intimidated, but it's really not that complicated. We are very motivated to make this easy and comfortable for the investor. We realize, these folks are sophisticated. They've likely done this outside of their IRA. They're just doing it with their IRA for the first time. So we're going to help you. We're going to accommodate you, and make sure that you feel confident and clear about what you're doing. Because again, we've been doing this for over 25 years as Midland, and now 50 years as Equity. So we do this day in, day out, and it's not lost on us that we're helping folks change their lives, and that this might be one of the most significant decisions that they make this year, this decade, in their investing life cycle. So we realize that, um, understand that it might be a little intimidating, but we're going to eliminate that intimidation as quickly as we can for you, and make sure that that you're taken care of, that everything is as it should be, and that you're not going to get any sort of undue tax bill on what you're doing, and that we're making sure everything's going right in the eyes of the IRS and the like.
Yeah, totally. And last question for me on diversification, and honestly, it's just a personal question because you see so many different asset classes and you kind of see them moving in different ways. Why do you think diversification is important at this point in the economic cycle? And
Mm,
I ask that because, a lot of folks invest in stocks, and I was looking at the PE ratio of the SPX, just the S&P 500 yesterday, and it was around 27 or 28, and the norm is around 23, 22, and just how expensive the stock market has gotten. Now, I'm a big subscriber to the AI revolution. Earnings might increase one day as well, but I feel like stocks are way overvalued. That's just my personal take. Love to kind of hear, what is your personal take? Why you think diversification is important at this point?
yeah, it's there's so many thoughts running through my head, Denver, because we sit here again on July 25th, 2024. The market sold off, like shaved off like 3% 2 days ago because of the earnings that are coming out right now. And just last week we had that CrowdStrike outage where we saw the blue screen of death all over. And for the audience, and I'm going to assume that most folks listening probably pay attention to things like CPI prints and core PCE and unemployment rates, and those have kind of given us some signals that things might be changing the market. Now, I'm not an economist. I'm not smart enough. I don't carry an advisor license or anything like that, Denver. But you know, I would be remiss if I didn't mention that I do observe these things as someone who's passionate about the investing community, and where I can find returns, where my clients are finding returns. Again, I'm not telling them where to find it, but where are they thinking, where they want to put their money. So, um, you know, it goes without saying that I think we've already said it in this conversation that the S&P has been performing great, and you point out some good indicators that say things might be overheating. So you don't want to be caught in a position where you've reacted too late to what the economy is telling you, or I'd much rather be too early than too late, right? We want to take those gains off the table because as we've seen, especially in not only like today's economy, but like in today's like the parlance of our times, the way that information can change our economic kind of situation so quickly. When we look at headlines and the political climate in our country in an election year, things can change really quickly. The past 2 weeks are no exception. So you don't want to be caught too late when the market's moved and left you behind, and that's what's gonna really impact the compounding effect of what your retirement account can do. Because if you stay in the S&P or stay in a strategy that has already kind of done its cycle, you're going to have less capital to take to your next deal. And it's those successful kind of deals in succession where we see, hey, someone plunked down $50,000 and earned a 26% IRR or whatever in a great commercial real estate deal. They take that entire balance and put it into a next deal, and they let that go for 5 years and get another 18 or 22 or huge IRR number, and then they roll it over again. And so in 10 years they've gone from 50K to just considerable balances. And if you stayed too long in the S&P, you might not be any, you might not even be, you might not even still have that original 50K. So diversification, I guess I'll put it this way, Denver, and I know I got long-winded, but it is something I'm so passionate about that, you could really knock out your ability to earn by staying in something too long. A lot of like I think something in the stock market, a lot of stock market philosophy is, the hardest thing to do is nothing. Just leave it there. But I would argue that our clients, have a problem sometimes with staying and doing nothing. Every 3 to 5 years, they're thinking of something else. So that the downside risk is just so great to not diversify that, especially if you're at a point, even in retirement where, you need to take cash out of your account in a down year, in a down market, you're losing money. So I'll leave it at that, Denver.
So, thank you for that. First of all, very interesting because you see a span of different investment classes. So clearly, there's many benefits to starting a self-directed IRA from all of these options. What are some of your top reasons that you hear from investors that are hesitant to actually stop, to open a self-directed IRA? What's that almost blockade that they can't get over, or that you'll have to do a lot more education to get them over the hump?
Yeah, I think it's right, that right there, Denver, is a lack of education. Folks, come to us thinking that if they open a self-directed account, move cash out of their IRA or their 401k, like we mentioned with a 401k rollover or an IRA transfer, they think they're going to get taxed on that movement. You're not. And so there's not a loss there. So I think the misconceptions, a lack of awareness, a lack of education about what an IRA is and how we fund it, and all these nuances that we've gone through today, Denver. I think that's a lot of what keep people from doing this, because it is such an impactful strategy. It's a way to achieve gains that you can't get, within, the public markets. So I think it's just that intimidation factor. Like, a lot of folks just, they fear what they don't know. And my job and my team is what our passion is raising the awareness that folks can do this. That, hey, you've got likely a considerable balance of capital to use to change your life within your retirement account. And let's talk about the ways in which you can do that. So again, Denver, I just say the biggest reason people don't move forward is because they don't know, or they're intimidated, or they're misinformed. So good on the audience today for getting informed.
Yeah, exactly. And great on the audience for listening in and just learning about a new way to really change your retirement dollars at the end of the day. Like that's what we're looking to educate folks on. And so, really glad that you're here with us, kind of talking about all of this. So we can jump to the next slide. Is there stuff that you probably have touched? We don't have to go through everything if you don't want to.
Yeah, no, and that's what I was going to say, Denver. We've really through our conversation, a really enlightening conversation, in my opinion, have gotten through a lot of this. Again, these are just common tips and considerations to you to think about when going the self-directed route. And we've covered all these. One, you got to use an IRA custodian. You can't go at it alone. So make sure you hire a professional or working with somebody. Investment subscription is made by the IRA, not the individual. That's what I was talking about with subdocs, folks. Like, we're not going to put our individual name. We're going to put our IRA's name and our tax ID on the subdocs. Cash flows, like if you're using your IRA, any dividends or income payments that your investment throws off goes back into your IRA. So it's not cash today, folks. It's not, I invest my IRA in deals, in a deal right now. That cash flow isn't coming to me. That's not mailbox money. That's retirement money. That's tomorrow's money. So all this cash flow is going within the retirement account. It's not coming into your it's not coming into your personal bank account. The lead time typically takes about 2 weeks to get set up, maybe 3 in some cases, but usually 1 to 2 weeks is what we're looking at in terms of like setting up a new IRA, funding it, and getting to a deal. Yeah, about a week or 2, folks. That's as long as it takes. So if you're looking at something closing in a couple of weeks, let's talk today. And then last kind of nugget there is that your active 401k, folks. So if you're working and you're under the age of 59 and a half, most likely you're not going to be able to access that 401k. They want to keep you in that plan while you're working for that company. The only caveat to that, that's why I put in most cases, some plans allow some 401k plans, some employer plans allow for what are called in-service rollovers, meaning you don't need that 59 and a half. You don't need that separation of service to get your dollars out of the plan. It's called an in-service rollover, and you need to talk to your TPA or your HR person who talks to your plan administrator to find out if your plan allows it. So if you're thinking, oh, I'm working, I got $100,000 in my 401k with my job right now, and I'm 40 whatever, probably not going to be able to use it. But you can ask your HR person or your TPA, hey, can I roll this balance out to an IRA? I think it's called an in-service rollover. Does our plan allow for that? You ask them, they should be able to find that out for you. Not a lot of plans allow for it, but it is becoming more in vogue, in my opinion. I've seen some investors get set up that way. So I mentioned it as it's likely off limits, but take a shot. So that's really all we wanted to talk about on this slide, Denver. As you mentioned, we really drilled down on all these topics previously,
Yeah.
with the exception of maybe that last one.
Yeah, that's great. And we get this question a lot. What fees do you charge? And we get that from every single investor. And so I'm going to turn that question to you. What fees
Yeah.
do y'all charge for starting the account, maintaining the account, investing in a private credit opportunity? Can you just talk through those fees so that people feel comfortable as to what they're getting into?
Yeah, and it's a great subject, Denver, because what folks should realize is that we're not a broker dealer, so we don't charge a commission. We don't earn a commission on products that our clients invest in. We're performing a service, an administration, and a record keeping for you, so that you're keeping your tax shelter in place, and the IRS isn't taxing you for what you're doing. So our fees, again, because we're not a broker dealer, we're not running your plan, we're not administering a plan. We're going to put our fees out there in front of you, transparent, and usually around administrative activities of your account, because we're real people behind the scenes doing meaningful work for people that matter, and our clients matter to us. So a human being is likely doing something for you. That's when we're going to charge a fee. But really, there's three main things that happen, right? So there's opening an account, there's funding an account, and there's making an investment. When you open an account, it's a one-time fee of $50. We charge it online when you set up. We actually don't charge you when you fund your IRA. We charge you when you fund your investment. It's a one-time transaction fee of $125. So there's 175 there in startup fees, we'll call it. The main fee is our annual asset holding fee, and it's a recurring fee. It is annual, but it's $350 a year to hold one investment. And again, we're transparent about that. We're not, burying it in a load fee with a investment product. We're not burying it in administrative fees of a TPA like your 401k might. So it's a flat fee. It's transparent, and it's based on what you're doing with the account. Most commonly, our clients are coming to us to passively invest in one private credit deal or one real estate deal or something like that. So whether they're bringing in 50K or $1 million, $350 a year to do one investment in an IRA, and it's a flat fee, and that we charge it, on the anniversary of the account. So if you came in today in July, we'll charge you $350 to do the, along with those ancillary fees, but we'll charge you $350 for the next 12 months, and then we'll charge you another $350. So, especially when you get to that $100,000 investment amount and above, very, in my opinion, insignificant. You're looking at under 10 bips, and so it's not impactful to returns. That's our MO, is to not impact your returns.
Yeah, and for the folks listening too, that's very competitive compared to the competitors as well. So if you're going to do a self-directed, you're going to see these three fees across the whole market, and these are very competitive rates. So appreciate you being candid about that.
Yeah, absolutely.
I'll go on to this next one. I think you touched upon pretty much all of this, but for folks that want to go to your guys' website, it's apply.midlandtrust.com. I'm sure it's a super easy process of just giving you as much personal information as you all need, and then it takes like about a 1 to 2 week turnover time for most investors, and then they can kind of figure out the funding process. So one of the questions is, do they have to reach out to their traditional or Roth IRA custodian, whether it be Fidelity or Schwab, or is that something y'all do for the investor?
Great question. So it matters on the source of the funds. So if it's coming from an IRA, we're going to get involved because it's an IRA to IRA transfer. And our status as a custodian allows us to kind of request those dollars on your behalf. You have to give us a signature on a form, but we'll then go to your current IRA custodian, Charles Schwab, Fidelity, and say, hey, Denver's looking to transfer $100,000 into his equity trust account. Here's the form to do that. We'll do that on your behalf. With a rollover coming out of an employer plan, we're not authorized on that plan. So the onus is going to be on the investor in that case, on the client in that case. So we're going to give you, after you've applied at apply.midlandtrust.com, which is accurate, by the way. Again, we were formerly known as Midland Trust. We're still using our old application because, again, equity likes how streamlined it is and how easy it is to use. So we've kept that, and the URL has remained the same. So that's not a typo or outdated. Apply.midlandtrust.com. That'll get you set up with our institutional services team. And yes, so we'll, you open up that IRA. If you're coming from an IRA elsewhere, we're going to quarterback that process for you. If you're rolling out of a plan like a 401k, we're going to provide you with direct, specific rollover instructions on what you need to tell your plan administrator, because again, we're not authorized on that plan. They're not going to listen to us. I'd have to go to my 401k if I wanted to roll over to an IRA and say, hey, John Hancock, I'm looking to roll over 50,000 to this IRA. Here's the delivery instructions, how to make that check payable. So again, IRA transfer, we're going to quarterback for you. 401k rollover, client is going to quarterback for themselves.
Fantastic. We asked all of the questions possible, but if anyone has further questions, there's a QR code on the screen that y'all can reach out to Adam about. If y'all want Adam's email as well, I'm happy to give it to you. Adam, thank you so much for your time today. Really, really appreciate it. And, I hope our listeners and investors learned a couple of things from you. And I hope, they come to open accounts at Equity Institutional Trust too. I think it's a great offering and a great platform for folks looking to kind of either just fund it themselves and open an account and, throw $7,000 a year from their bank account, or do a rollover and really change the trajectory over a long period of time, which, we've all heard, like making small changes over a long period of time add up to a lot. So really appreciate the time, Adam. And yeah, we'll definitely be in touch.
Sounds great, Denver. Thanks so much for having me. I really enjoyed our conversation and the opportunity to present to your audience today. I do welcome anybody to reach out to me directly. I'd welcome the opportunity to be a resource for you, for your family, for your network, for any other deals that you might be looking at to invest your IRA in. So please don't hesitate to reach out to me directly via email or phone. That QR code will allow you to access my calendar to book a meeting. So please don't be shy. As I hope I've communicated, I'm very passionate about this. So I'd welcome the opportunity to help anybody. So thanks again, Denver and JT Capital, for having me. It was a great time.
Fantastic. Thanks, Adam. Thanks, everyone. Take care and have a great evening.
Thanks, Denver.